Hello and welcome. In the world of corporate finance, some of the biggest decisions, the real game changers, they happen behind the scenes. They're often hidden in the pretty dense complexities of the tax code. Today, we are going to pull back that curtain on one of the most fundamental choices a company ever has to make.
We're diving deep into that age-old question. How do companies raise money? Is it better to borrow it, that's debt, or sell off a piece of the company, that's equity? But we're going to look at this through a totally different lens. Think of it like a hidden battle fought on the battlefield of taxes, where the real cost of capital, well, it isn't always what it seems on the surface.
So, let's kick things off with what sounds like a really simple question. Imagine a company has to choose. What's more expensive, borrowing money and paying 8% interest on it, or issuing new shares that pay out a 7% dividend? I mean, on the surface, the answer seems pretty obvious, right? 7 is less than 8, end of story. But once taxes get involved, the math gets a whole lot more interesting.
So here's our game plan. We're going to start with that simple choice. Then we'll dig into what this really costs the corporation. After that, we're going to flip the script completely and look at it from the investor's point of view. We'll see how those two worlds connect, solve a tricky little puzzle about a special type of share, and then, finally, we'll wrap it all up with the key takeaways.
All right, let's set the scene. Picture this. A company needs to raise $100,000 to get a new project off the ground, and they've got two main options sitting right there on the table.
Okay, so option A is debt. They go to a lender, borrow the $100,000, and agree to pay 8% interest. That's $8,000 a year. Simple enough. Option B is equity. In this case, it's a specific type of stock called preferred shares. They sell $100,000 worth and promise a 7% dividend, which comes out to $7,000 a year. Now, just looking at these numbers, option B looks like a total no-brainer. I mean, it seems like you're saving a clear $1,000 every single year. But are you really?
To find the real answer, the one that actually matters, we need to look at the corporation's after-tax cost. And this, right here, is where the whole story flips on its head. It's all thanks to the incredible power of tax deductions.
So here is the absolute #1 rule you have to know in this tax battle. Interest is a tax-deductible expense. What does that mean? It means when a company pays interest on a loan, it gets to subtract that entire payment from its income before it calculates how much tax it owes. It's treated just like paying salaries or rent.
The math for this is incredibly simple, almost beautiful. To cover that $8,000 interest payment, the company needs to generate exactly $8,000 in pre-tax income. It earns the money, pays it right out as interest, and boom, the taxable income from that specific slice of business is zero. So the true pre-tax cost of an 8% debt is, you guessed it, exactly 8%.
But equity, oh boy. Equity plays by a totally different set of rules. You see, dividends are not a business expense. They're a distribution of profits to the company's owners, the shareholders. And this is the critical part. The company has to earn its profit, pay the full corporate income tax on it, and then it can pay dividends from whatever is left over.
Let's work backwards for a second to see the true cost. The goal is to get $7,000 into the shareholders' hands. Now, let's assume the corporate tax rate is 27%. That means the $7,000 is the 73% of profit that's left after the government has taken its cut. So to figure out how much the company had to earn before tax, we just divide that $7,000 by 0.73, and it comes out to a staggering $9,589.
And there you have it. This is the shocking result of that hidden tax battle. The 8% debt cost the company a clean $8,000 in pre-tax earnings. But that supposedly cheaper 7% dividend, it actually cost the company almost $9,600 to pay. To put it another way, the true pre-tax cost of that 7% dividend is almost 10%. Suddenly, from the company's perspective, debt is looking way, way more attractive.
But wait, that's only half the story. A company can't just think about its own costs, right? It also has to think about the investors who are actually going to buy this stuff. So let's do a complete 180. Let's shift our perspective and look at this whole thing from the other side of the table. Now this reveals the other equally important side of the tax equation, and the differences are just huge. An investor's tax bill depends entirely on who they are and how they're earning their money. For instance, a high-income individual might pay a 50% tax on interest income, but only 35% on something called eligible dividends. But now look at a public corporation that's investing in another company. They pay 27% on interest, but get this, zero tax on those same dividends. It's a classic case of one size definitely not fitting all.
Let's make this really concrete. Imagine a top-bracket investor whose only goal is to pocket $50 after taxes. This table shows what they'd have to earn before tax to hit that goal. To get $50 from interest, they actually need to earn $100 because half of it is going straight to taxes. But to get that same $50 from a dividend, they only need to earn $77. And for a capital gain, even less, just $67. 3 totally different paths to the exact same $50 result.
This chart really drives the point home. Let's say a 10% interest return is our benchmark. What kind of dividend would give different investors the same amount of cash in their pocket after tax? Well, for a low-bracket individual, it's 8%. For our high-income investor, it's 7.7%. But for that public corporation that pays zero tax on dividends, a much, much lower dividend of just 7.3% gives them the exact same after-tax return as a 10% interest payment. That's a huge efficiency gain for them.
So here it is, the crucial connection. This is where it all comes together. On one hand, we have the company, for whom debt is cheaper because that interest is tax-deductible. And on the other hand, we have certain investors, especially other corporations, for whom dividends are way more attractive because they're taxed so lightly or not at all. The smartest companies find a way to operate in that perfect sweet spot between these two opposing tax realities.
And that leads us directly to this core insight. Raising money is never a one-way street. It's really a negotiation, a dance, in a very tax-sensitive marketplace. The companies that really succeed are the ones that structure their financing to be tax-efficient for themselves while also making it incredibly tax-attractive to a specific group of investors they want to bring on board.
So how do they actually do this? Well, they offer a menu of options. They might issue common shares that pay very low dividends, aiming for high growth instead. This is perfect for individual investors who are looking for those lightly taxed capital gains. At the exact same time, they can issue high-dividend preferred shares that are specifically designed to be attractive to other corporations who, as we know, can receive that income completely tax-free. It's all about tailoring the financial product to the right customer. Okay, let's use those preferred shares as one final case study to see just how deep these tax strategies can actually run. We already know they're more expensive for the company that issues them, but it turns out there's another potential tax complication that makes things even more interesting.
And that complication is something called the Part 6.1 special tax. It's a 40% tax that kicks in on preferred share dividends over $500,000 a year. Now, at first glance, this sounds completely insane, right? It takes an already expensive way to raise money and slaps a massive 40% tax on top of it. Why would anyone ever do this?
But here is the brilliant twist. This tax is designed to be paid and then immediately recovered. Think of it like a security deposit. A normal profitable company pays this special tax and then gets that exact amount credited back dollar for dollar against its regular income tax bill. So for a healthy company, the net cash effect is zero. It's not a penalty. It's a very clever mechanism designed to prevent certain tax loopholes.
So the strategic trade-off becomes crystal clear. The risk, of course, is that if the company hits a rough patch and stops being profitable, it stops paying income tax. That means that security deposit is never returned, and it suddenly becomes a very real cash cost. But the benefit can be huge. Issuing preferred shares boosts the company's equity, which strengthens its balance sheet. And a stronger balance sheet makes the company look safer to lenders, which allows it to go out and borrow more money through that tax-deductible debt, and probably at a cheaper interest rate too. It's a long-term strategic chess move.
Okay, we have covered a ton of ground here, from the company's cost all the way to the investor's return. So let's bring it all home and distill this down into the most important lessons. First and most importantly, never ever trust the headline rate. The after-tax cost is the only number that truly matters to a company. Second, the capital market is not a one-size-fits-all world. Every single investor has a different tax situation that smart companies can and should cater to. And third, a financing decision is never just about raising money. It is a powerful strategic signal about the company's health, its plans for the future, and exactly who it wants as its financial partners.
So the next time you see a headline about a company issuing new bonds or selling new shares, don't just see it as another news item. Ask yourself, what's the hidden story here? Who are they really trying to attract with this specific offer? And what does that signal about the company's overall strategy? Because so often, the answers are hidden deep inside the tax code. Thanks for joining me for this explainer.